Welcome everybody today to the May 2023 market update. Can you believe it's already May 2023? It's amazing. I am Cindy Bishop with Cindy Bishop Worldwide, and the topic for today is our monthly market update, which Jolene Moore has been generous in doing for many years and really helps agents know and grow. It really helps agents also navigate through what's going on right now. And I think that Jolene is just excellent at it. A lot of people can't do this. It's just really takes a lot of skill and ingenuity to be able to pull this off. So our speaker, Jolene Moore, is a top producing lender. Her knowledge of market intricacies as well as her attention to detail cause her to be one of the best mortgage finance authorities in your market today. Jolene has an abundance of experience and a keen ability in the real estate lending field. She is not only a top producing lender nationwide, she's also a vice president and senior home loan consultant. I'm getting tongue tied here with Cross Country Mortgage. She is also a well-respected and sought after trainer with Cindy Bishop Worldwide. Over the next couple of months, Jolene will be offering some amazing trainings through Cindy Bishop Worldwide. So keep an eye out when you go to Cindy Bishop Worldwide to upcoming events, or just email me if you're looking for Jolene Moore trainings. As a result, you'll be able to access. I'm trying to put their names in the instructor part, so you should be able to search them when you go in. But Jolene is unique in that she does business building that is really second to none. So make sure you also look for that on webinars, as well as her market update and her CE classes that she teaches. Take it away, Jolene.
All right, thanks all. Thanks for being here today. Yeah, it's crazy. It's been over 3 years that we've been doing this market update. We started in 2020. So so what we're going to touch on first is interest rates, just to kind of give you an idea of where rates are going, or where they are. So the Feds did start, today is Tuesday, so they started their meeting today. They will make their announcement tomorrow of what their decision is. This expectation is they are expected to increase their rate by 0.25%. So it would be surprising if they don't, or if they do more. And if that does happen, then you could see more volatility with the interest rates and with the market if they don't do what the market is expecting. The job reports come out the first Friday of every month. So those will be coming out this Friday. Again, the job numbers is a big market mover. That's actually, we are kind of on a good trend starting the year. And then in February, the job reports came out showing that there was more jobs created than what was expected. And that's when we kind of started seeing the volatility of interest rates again. And we jumped back up into the sevens. Right now, the expectation is the JOLTS report came out, and I think it's job and openings and labor, I think is what that stands for. And it's basically showing how many jobs are available. And it was showing less job openings than expected, which means that the job reports may come out on Friday, not as strong as what might be anticipated, which means it may have a favorable effect on interest rates. The other thing that's coming out next week is inflation numbers. So our CPI, the Consumer Price Index, that comes out, I think it comes out next Tuesday. That also is a huge market mover. It comes out on the 10th, which I think is Tuesday. And let me see. Nope, Wednesday. Because inflation is also what has driven our numbers up. So what the Feds are doing and raising their rate, has all been inflation driven, because their goal is to try to push inflation down. So they're raising their Fed fund rate in order to achieve that goal. Each month, those inflation numbers come out. And when we see what the Feds are doing or having a positive impact on the inflation numbers, then that's when we start to see our interest rates improve. Because once the Feds hit their goal of where they want inflation to be, and they can stop increasing the Fed fund rate, that's when we will start to see our interest rates improve. There's an anticipation in our industry, in the mortgage industry right now, that May 10th could be a big day for us, and we may start to see rates improve based on the inflation numbers that are anticipated to come out. That again will be in our favor, show them improving, and that we might be able to see the market start to improve and do it for a period of time. And not, up and down each day or week, because that's basically what we've been seeing since February. As Cindy mentioned, I changed, we opened our own branch, my team and I did a couple of weeks ago, and we moved over to Cross Country Mortgage. And there was about a 4-day period where I was waiting for my license to be transferred over and wasn't able to price out rates. And from that 4-day period, interest rates moved up 0.5% in that time period. And it was basically each day they moved up about 0.125%. So in that time period, I was like, what the heck? That's how volatile rates can be, And so when you have clients that are talking to multiple lenders, they really need to make sure that they're talking to those lenders on the same day, even the same time of that day, same time period, because what might happen in the morning, like instance, yesterday morning, the market opened up. It wasn't super favorable for us, but the pricing comes out. We get our interest rates more, daily. Usually about 10:30 is when you start to see the pricing come out for all of the interest rates and our investors. By that afternoon, the rates had worsened and we got a reprice for the worse. This morning, the market opened up positive. So we were getting a little back of what we lost yesterday. By this afternoon, right before we got on this class, we actually got a reprice for the better, which interest rates were improving. So that's what I'm saying is these rates are moving constantly. So it's not just week to week or day to day, it can be hour to hour. So to make sure that those clients are getting a true comparison, they really need to talk to the lender within that same time period of the day to know exactly what they're dealing with. Debt ceiling, this was something else that came out in the past day or so, is that Janet Yellen mentioned that the government could run out of money and have trouble paying its bills by June, which means that they may have to look at increasing the debt ceiling. There's going to be some ramifications associated with that. In the past, when this has happened, I think the last time it happened, it was in 11, where it was kind of down to the wire, is right at the very last minute that there was changes made, and that had an impact on interest rates and to our favor at that time. But again, it's just something to keep in mind. And that's what my goal is here with this update, is to always just make you guys aware of what's happening in the industry and what to be looking out for, what to be listening for. So if you see things like that, what impact is that going to have on us in our industry? In real estate, the debt ceiling could have an impact. It could actually, be positive depending on how things go and where that turns. Again, Cindy mentioned early on, and I know many of the names I see on here, you guys come, each month, and I really appreciate that. And I hopefully that means you're finding value in it. But if you have questions, put it in the chat or unmute yourself. I love interaction. Like Cindy said, it's really hard to just talk to a screen. So I'd love to hear from you guys. So if you guys have any questions, again, unmute yourself or put it in the chat. All right. So market information, you guys might have heard as well. There was a couple banks that were were taken over or had issues earlier this year. There's a third one now, First Republic Bank, and that was absorbed by Chase. First Republic was actually very prominent in the mortgage industry. You weren't probably seeing it, but on the back end, they were an investor and they were offering some really, really low rates. And sometimes, unfortunately, that's what's happening with some of these regional banks, is they're offering super low rates, and then that's putting them into challenges because they lost a lot of deposits. And because of that, they were absorbed by Chase. So regional banks, we may find as we go along, are going to continue to struggle. And we're going to see some of the larger banks become more prevalent and take over, and have more of the deposits in the US. So something just to keep an eye on and keep aware of yourself as well, and where you have your funds. CoreLogic. CoreLogic came out today, this week, and announced that home prices were up 3.1 year over year in March versus last year. And this is nationwide, so not specific to our area. And they believe that it's going to rise 4.6% over the next 12 months. So obviously, we've had a lot of clients talking and worried about the home market, the housing market. Their price is going to fall. I've had many clients say to me, I'm going to wait until prices come down. As we can see, we're not seeing the absorbent increases that we saw, in 20 and 21, which is good. We're seeing moderate increase. But the reality is we're continuing to see increase because, as you all know, we have very low inventory based on the demand. And as long as that continues to hold, that's going to drive prices to continue to stabilize as well as increase. And when you look at our numbers, this average sales price here of 8.93% increase, that was in the Northern Virginia area. So in Northern Virginia, Realtor Association said from March of 23 to March of 22, we saw an average sales price up 8.93%. So again, if you look at that CoreLogic article, it mentions that there, across the country, housing markets are different, right? The bigger metropolitan areas are rebounding and are seeing increases, which is what we are seeing in our area. So when you average that to some other areas, they are not seeing the increase that we are. That's how it's averaging out to the 3.1%. So keep that in mind. Again, it's all about education to your clients and making sure they understand the headlines and what's happening in our market, as opposed to nationwide, because there are markets that are struggling, they're decreasing. We're not seeing in our market. So we got to make sure that we let everyone know that. Now, home sales are down, and that's a lot to do with the listings, right? We have minimal listings and we have low inventory for our listings. So therefore we're going to have lower sales. So our sales are down 32% from March 23 to 22. So again, that's why we're seeing the pricing increasing as well, because we have minimal, inventory and it's struggling for clients to find a home. Now, some of that, and I'm sure you guys are all know, and here is because of the rates that we had for 20 and 21, where the rates were so low, that, we are seeing people staying in their house, because they don't want to give up that rate. Or if they're selling, they're like, well, we're going to rent it because we can rent it and cover the mortgage because it's so low because we have such a low interest rate. So those are things that are going to evolve. I think it's kind of a time period we're in right now. It can't stay that way. Obviously, people are going to have to move at some point. I think also as rates start to improve and we close that gap a little bit of where they were, now versus where the rates are, and if we close that a little bit closer, then that's, I think, going to allow people to feel more comfortable in moving and maybe taking on a higher interest rate.
Jolene?
Yep.
The average sales price you say is up 8.93%. Are you having any problems with an appraisal on these?
Not so far. I haven't. No. And like I said, it's an average. So obviously we're not seeing it across the board. But most of I have not so far. I think I've had a couple come in low. I had one that was 10,000 low. I did actually have one in Maryland that came in 25 low. That was and that they did negotiate because it did have an appraisal contingency. So we've had a few, but I would say the majority are coming in at sales price.
Okay.
All right. And then at year-to-date average sales price for the entire year, we're up 3%. So, in line with what the average they were seeing just for March. And then year-to-date homes sold is down 30%. So again, our sales, our units are definitely struggling, and hopefully we'll see that, as rates start to improve, we'll see that improve. And I know that there's an anticipation that the summer we could have, a decent market. We might have a slower quarter, Q4 and the first quarter, but as rates start to improve, I think next year is anticipated to be a pretty strong purchase year. So we'll see what happens. Cash sales, we're at 18%. So those have moved up a little bit from last month. All right, some lending information. Soft pull credit. I've been mentioning this for a few months, and with the change in the company that I just moved to, we actually have a couple more options than I had before, which I'm really excited about. So what we're doing for most of our clients who were getting pre-approved, we have two options when it comes to soft pull. We can pull all 3 credit scores. So we get all 3 bureaus, and we get all the credit debt that's going to be associated with those bureaus, but we can't run it through the automated underwriting system. Or we can pull one score and get the one credit score and the debt that's been reported to those bureaus, and we can run that through the automated underwriting system. So if we're tending to do all 3 scores first because it gives us a more overall picture of what the middle score looks like, what all the debts are, things like that. If it's a very strong client, and we're not worried about the debt to income ratios, their income is strong, their credit scores are strong, all of that, then, we're going to leave it at that. If we have concerns with the credit score or the DTI is a little bit on the higher side, then we're going to shift and be able to run it through the automated underwriting system. So for the most part, we probably won't be doing a hard credit until we're either writing the offer or when we have the ratified contract, because we have so much information now with that soft pull. So it's really helping clients, I think, feel more comfortable being able to fill out the application, get the information, really kind of engage them in the process without the concerns of the inquiry on the credit report. So I think that's been really favorable for almost every client that we've had lately. Where we are now at Cross Country, we have really competitive jumbo arms, which I'm very excited about as well. Now, this is going to be for any loan that's above the conforming loan limit. So it's going to be 726, 200. Any loan above that is going to be considered, you can do it as a jumbo loan, even if it's not officially a jumbo loan. They are going to require 20% down. I have so many clients ask me about ARMs. Can I do an ARM? Can I do an ARM? The reality is unless it's over 726,000 loan amount and they're putting 20% down, ARMs are just not competitive right now. We're in an inverted yield curve, which means that those pricing of ARMs are not competitive or not favorable for most investors. So there's just not a lot of possibilities with that. So again, we'd have to be in that price, that loan amount range and loan to value in order for us to look at doing ARMs and then make sense. We also have a rent, I had a client reached out the other day that has rented, the property needed a lot of work. It was not going to pass the muster for a conventional loan. So we were going to have to look at doing a renovation loan, and they were buying it as an investment property. So the good news here is we do have an investment renovation program. It's going to require 30% down. But again, that's not something I've had in the past. So I'm excited about that. So that if you have clients that are looking to do a property that needs renovation and it's not going to be their primary home, we do have potentials to help them with that. We also have 100% construction VA financing. Again, that's something that's being built from the ground up, 100% financing with their VA. It's a veteran who's eligible for that. So again, not all of these are going to be things that you're going to be using all the time, but it's just good to know what's possibilities. So that's why I want to mention it. The other thing is I'm sure you guys saw in social media, in the media, and all over the place over the past week about the changes that Fannie and Freddie made. If you guys have been coming to this market update, I've been mentioning it since it was announced in January. So hopefully you knew what was happening before you saw all of the heyday going on social media. The reality is, and I think I showed a chart last time too, that there was some changes made to the pricing on the back end. So it's not something that the client is even really fully aware of unless it, hadn't been all over social media, was that they made some changes. They added some tiers of credit scores. It used to be 740 and above was the same interest rate. They've now broken that out and it's 740, to 760, 760, 780. There's different pricing associated with those credit tiers now. Lower credit scores now had more favorable pricing for them. Still worse pricing than those that had higher credit scores, right? So it's not like the lower credit scores are getting better interest rates. It just means they were getting better rates than they were before. They're not getting better rates than those that have better credit scores than them. And so there's just some, different tiers. And honestly, 5% down right now might be more favorable interest rate wise for a lot of clients versus 20% down. So there's, just situations where we might try to suggest and educate the clients that may lead them to putting less down and if it gives them a better interest rate. So it's just really up to the lender to make sure that they're working with the client and helping them make the best financial decision. And in that regard, all those changes that went into place, if you're a first-time home buyer and you're the area median income, I think it's 120% in our area because we're a high-cost area, which means most of the market, if you make less than $168,000, you are exempt. Ooh, I forgot it. I'm missing the M. You are exempt from those changes, which means you're going to get a better rate if you are a first-time home buyer and you make less than 168,000 in most of our market, which again, making sure that the lender is aware of that. So it can be I would say the difference in rates, probably 0.25%, is what we're seeing so far when you have that exemption. So something to keep in mind. And again, it's all about educating your clients and helping them understand that. So who's paying cash? Owner, occupants, investor, individual investors. They don't break that out, Cherry, to say who's paying cash. When I look at like the Northern Virginia Realtor Association and those types of things, they basically just say what percentage of the transactions were done in cash. So I don't know. I would say that from what I've encountered with the transactions that my clients are going up against when there's cash, there's many that are buying it as primary residence, but there's obviously many that are doing it as investment. And again, it could be properties that can't be financed. It could be, I know there are a lot of companies that people are talking about are going in and buying other properties in certain neighborhoods and stuff. So there's all kinds of different potentials there. Does the ARM product also have a credit score minimum requirement? Yes, all ARMs are going to have a minimum credit score, and it just depends on the loan amount, the program, all that kind of stuff. If it's like a conventional ARM, it's going to be the traditional like 640, but again, it's not going to be priced well, so it's not going to make sense to go because credit scores in general, like we're talking about, they have an impact on the interest rate. So the other thing I'll say is FHA is definitely something that's going to become more prevalent because of these changes to interest rates, because the change of the lower mortgage insurance that FHA has now. I have more clients that it's more favorable for them to look at going FHA than it is to go conventional. So again, keep that in mind on your listing side of things, that don't knock them out because it might make sense just because of changes that are being made by Fannie and Freddie, and that it could make more financial sense for them to go with FHA. Same thing with VA. I've mentioned it many, many times, but VA, like I had a client that I was talking to over the weekend, and he was putting $200,000 down. And he's like, do we go, he's a veteran, or he's currently active duty in the military, so we can use his VA eligibility or conventional. He really wanted to use the VA eligibility. It made the best sense because the rate was lowest. His funding fee was reduced because he was putting so much down. So long-term, him planning to stay in this home for 30 years, the VA made the best sense for him. And fortunately, the listing agent understood that, and he won the contract. So again, helping educate everyone to know that VA. I will tell you, I had a loan approved a couple of weeks ago where the debt to income ratios on a VA loan was 70%, and it got approved through the automated underwriting system. So if you think about any loan that is the most relaxed on guidelines, that has the most flexibility, it's VA. So on a listing side of things, you really, when you take a VA contract, it's going to be rare that it would be denied because there is so much flexibility in that program. So think about that when you look at those contracts, and really the contract that's going to has the best assurance to me is a VA contract. So think about that. All right. Thank you for the reminder on FHA. That's important to know. Yep. Very good. Yes. All right. So now that we kind of talk about tips for, transactions that we've done in the past month, retired borrowers. I just did a video on this on Instagram and all of our social media. Again, I think you guys, I mentioned in the last class that, the numbers that came out from the National Realtor Association last year, that a big portion of the buyers last year were baby boomers and younger baby boomers. So there's still plenty of baby boomers out there who are purchasing homes, and they need to know that they can. So we have worked with a lot of retired borrowers lately and helping them be able to derive income from their retirement assets to help them qualify to purchase. So we want to make sure that we're getting that information out there and let them know that it's a possibility, because there's a decent amount of, retired borrowers think they can't qualify, when actuality, they have a very, there's many ways to help them qualify. Recasting. I've mentioned this many times, but I'll tell you what, we did a video on this. We've been doing this kind of push on social media where it's 90 days of impact. And we started on April 1st, where we're posting something every single day on our social media. And one of those was recasting. On our Facebook page, we have 48,000 people that have viewed this recasting video. I couldn't believe it. I was like, oh my gosh. Recasting is very popular. So if you haven't done a video or you haven't told your clients about it, get it out there and let them know that it's a possibility. Because I will tell you, out of the transactions that we did last month, a high percentage of them were carrying two homes, like we're saying here. They're qualifying, carrying both their current house and their new house. They're going to sell their current house after we buy the new house. They're going to take the money from that they make off of that sale of their home and apply it to the mortgage, and then have their mortgage recast, and they readjust the principal and interest payment. It's a $300 to $500 fee to do that, so that they can get their monthly payment down to what it would have been if they had sold their house first. So recasting is really, really popular right now, and very prevalent in helping clients understand what their possibilities are, so that, you know that they don't have to wait to try to sell their house first, or a bridge loan. Everyone loves saying bridge loan. Bridge loan is one of the most expensive options that a borrower could do. It's, lots of closing costs, points, all that kind of stuff. So doing the recasting option, putting the minimum down initially, and then doing recasting is such a better option for clients. So recasting, share that. Quick closes on VA. Back to the VA contracts. That's another thing I've had clients and agents ask me about. We've closed a VA loan in 14 days. We can close in 21 days. They have the stigma that VA takes longer to process, as well as FHA, is just not true. VA and FHA has the ability to close quickly, just as the conventional loans do. Maybe not as quick as conventional for VA. FHA is just as quick. The VA, you probably need at least 14 because you got to account for the appraisal. But it's something that can be very competitive for your clients. So keep that in mind when you're working with veterans. Divorced, I've mentioned this before, but again, this came up last month. We had a client who was buying out her spouse. And when you do that, you can do it as a rate and term refinance, so that it means that it's not a higher interest rate, because when you do a cash out refinance, it's a higher rate. And that can help clients when they're getting divorced and one's going to stay in the house and the other one is going to move out, and they got to buy out that spouse. I've done, I think, a divorce class 2 months in a row, and we've had a lot of people in that class. So that's something also very popular right now, unfortunately. So if you guys need some ideas for videos, recasting, divorce, VA, qualifying to carry 2 homes, those are four topics right there that you can work on and put out videos and put out information to you. If you don't want to do it on social media, just do it and put it out to your sphere, and just record a video and text it to people, whatever you need to do, so that you can get that information out there and share with people. Okay, so I did a recast, and literally no clients know what it is. How long can you recast after you buy? Recasting, what I tell clients when they purchase, they need to plan to wait at least 90 to 120 days before they'll be able to recast. And then after that, then, whenever they choose to do it, they can do it. Now, again, we'd have to talk to the servicer. Some of them may only allow them to do it once. So there's are things that you'd have to look at, and that could be lenders, investor specific. So you usually are going to have to anticipate waiting for 90 to 120 days. Keeping in mind, they skip 1 month's pay when they buy the house, all that kind of stuff. So it could only be a couple months where they might have to pay the higher payment. So something to keep in mind regarding that.
See, Jolene?
Yep.
The reason why I asked is because I did a recast with my own loan, and with Chase, they required me to do it before my first mortgage payment because I was selling my other home. But then when I was with Wells Fargo and I did a recast, they made me wait 4 payments in. So it was really different.
Well, and that's the thing. It could be, and it could be investor and servicer specific. Like my last company was at 90 days. So is at 90 days after your loan was transferred for servicing, you were eligible to be able to recast.
Okay. All right.
And I would say that's what I've heard from the most part, is that's kind of been more of a commonality. I've never heard where you have to do it before your first payment, because the reality is that most of them want you to wait till it gets set up for servicing before they're going to allow you to recast. So that Chase situation, I think, is very unique.
Yeah, it's weird. And that was back in 2018 when I had Chase and I did that.
Okay.
So I don't know if it changed since then, but that was.
I bet you it has.
Okay.
Because that I've not heard that from any client that I've worked with.
Yeah, because Wells Fargo, when I did that one, that was 2022, where they made me wait 4 months before my first 4 payments before I could actually do the recast.
Yeah, and so it is going to be investor specific, and like I said, with the company I was with previously, it was 90 days from the day it was transferred. So that's why I say 120, like 90 to 120 days, because it all depends on when it's transferred and when that 90 days starts.
And is it only for conventional loans?
Yes. Well, jumbo, there are jumbo investors that allow it as well. Fannie and
But
Freddie,
no VA, FHA.
correct. No government loans. Yeah, and that's where, like, I had a client last year where we were doing, this 5%, looking at carrying and all that kind of stuff. We went conventional instead of VA so that they had the ability to recast. So that's a conversation I'll have with the client to help them know what their possibilities are. So if their plan is to recast and they need to do that, to get that payment where it's more comfortable, then they're going to want to do a conventional loan versus a VA loan. And then they can always refinance later into the VA loan, down the road when the rates make sense. Recasting doesn't apply for, yep, you're right. Where can I find your recasting video? It's on our social media, and we'll send it to you, Charles, as well. I'll have Leslie, my assistant, send to you. And I do send it all. You guys, like Shinchin, you should be on my email distribution, and it all comes out through there too. So just so you guys know, we send out a video every Wednesday morning. So if you don't see by noon, if you don't see a video by us, it's probably in your junk. So if you want to, mark it on your calendar, Jolene's going to be sending a video. We're send tips. We send all kinds of information out every Wednesday morning by 12 o'clock. And we sent this recasting video that way. And then we put it all in our social media. So we will send it out to you guys again, just to make sure you have that. All right. Anyone else have any questions? All right. That's all I got for you guys today. Here's our new information, our new team
So,
picture as well.
Jolene,
Yeah.
can we post your video on our website?
I'd love for you to. Yes, that's what, you guys either take it and do yourself or take mine and share it, whatever works best for you. But yes, all of our information can be shared. We're totally fine with that. But here's all our contact information. You can see our number, the 571-800-0710 is our team number. So save that in your phones, and you can always get a hold of one of us here at the office. There's our team email as well, team@jolenemoreteam.com. So again, if you email that, one of us will respond. And then the website, jolenemore.com. The link there is to fill out the application. All of our information has been updated there as well. So reach out to us if you guys need anything, have any questions. We're always here to help.
Where are you located now?
We're still in Fairfax.
Okay.
We're just on Fair Lake Circle. So it's about 5 minutes from my office where I was. So super close. But we have a great conference room, so we'll still be having classes face-to-face down the road. Appreciate all of you guys. And if there's anything you need, reach out.
Thank you.
All right,
Thanks, everybody. Take
All right,
care.
take care.
Bye.